Happy morning, friends. Welcome back to IC38 exam refresher course, and happy to see each one of you preparing towards your examination and for the business success in future. Right. So we are now into chapter 6. Chapter 6 is about pricing and valuation in life insurance. I am sure you would have seen the modules of the first 5 chapters along with the sample questions in the Q&A videos. So keep do practicing the sample questions. This is completely keeping in mind the exam focus. So let's move into understanding chapter 6, which is pricing and valuation in life insurance. So what are we going to discuss in this chapter? We would see it in two basic concepts. One is insurance pricing and then the surplus and bonus. So we will understand more about the pricing and surplus in this chapter. So let's go one after the other. The four basic elements of insurance pricing includes premium, rebates, extra charges, and how do we determine the premium given to the customer. So we will understand every element in specific. So let's start with premium. So if you understand, the premium denotes the price that is paid by the customer, right? So for instance, I meet up with the customer, I suggest him to take a product, I explain the features of the product, and I also tell him what premium he has to pay to the life insurance company so that he enjoys the maturity benefits which we have explained. So for every product, the premium is calculated, and needless to reiterate, we have seen this earlier as well. The premium depends completely on the age. So lower the age, lower the premium; higher the age, higher the premium, considering the closeness towards the risk, which is death of the life assured. Right. So premium rates usually are available in form of a table from every insurance company, and these table premiums which we suggest to the customer are known as the office premiums. So for all of you watching this video, I would only suggest make note of these terminologies. Probably these can lead you to some questions in the examination. So little bit more on premium. Individual pays premium to the insurance company, and the insurance company provides insurance cover to the individual for the term agreed based on the terms and conditions of the product chosen by the individual. Right. So this is about the first topic which we discussed out of the four elements. First one was premium. Now we will look at rebates. So life insurance companies offers two different official legal rebates to the customers. It is rebates are nothing but sharing the profits made with the customer. So rebates are of two types, either based on the sum assured or based on the premium mode. So if somebody takes a higher sum assured, right, so he gets a rebate. Why this is being given? It is very simple. It is like passing on the profits made to the customer or passing on the gains made to the customer. So what is the logic behind giving this rebate on sum assured? The effort and cost for a small policy with low sum assured or a bigger policy with high sum assured remains the same, but the profit is different here. So the profit made by the life insurer is passed on to the customer as a sum assured rebate. There is a second rebate which is given to the customer, which we discussed earlier. It is based on the premium. The assumption is that the entire premium is paid on a yearly mode, and the life insurer will be having the premium with him for investing for the entire year. So that makes if a customer opts to pay premium in yearly mode, the customer will be getting a yearly mode rebate as well. So the flip side of the statement, if he chooses to go in for a monthly mode, if he chooses to pay premium on a monthly mode, he would be paying a little extra when compared to yearly mode. Similarly, the other modes available: monthly, quarterly, half-yearly and yearly. The four different modes available in life insurance policies. Right. So moving forward, there are extra charges levied upon customers. Certain customers on certain conditions. So who are not to put it in this way, there can be an extra premium charged to a customer if there is a additional risk, and this additional risk can be due to substandard life selection, like based on health conditions, right? So there will be a premium which is levied extra for this customer who has a health condition, and we call it as a health extra. Similarly, somebody who is working in a riskier job, hazardous job, there will be an additional premium levied for these type of customers, and we call that premium as an occupational extra. Okay, we are into determining the premium now, a part of chapter 6, right? So what we are going to discuss in this particular section in this chapter is how the premium is arrived and shared with the customer for him to make the investments for a particular term. So there are certain components which are considered before giving the final premium to the customer, and we will discuss about those components in detail. So it starts with mortality, interest, expense of management, reserves, and bonus loading. So for each of these components, let's understand a little bit more in detail about these components, on how these components impact the final premium of the product. So determining the premium, mortality rate is the first element. So depending on the age of the person, using the mortality table, we can identify the cost to be added to the premium against this particular heading. Okay, let me explain mortality with an example. For instance, if the mortality table says that out of the 1,000 people who are alive at the age of 35, 3.5 people will die. That means the mortality rate would have been in the table as 0.0035. So and the assumption is this rate of death will happen between 35 to 36. So we know that for a 35-year-old person, the life insurer will charge him based on the mortality table, right? So similarly, the assumption also goes in this way, that if this premium is charged at rupees 3.5 per thousand sum assured for a 35-year-old person, this particular premium is called as the risk premium. And there is another component which comes into deciding the premium to the customer, which is the interest rate. So based on the interest rate, the loading means the increasing or decreasing the premium is decided. So let us put it in this way, in a nutshell: if the interest rates are assumed high, and the premium would become lower today. Similarly, if mortality rate is assumed as high, the premium will be increased to the customer. So that's one of the reason why lower the age, lower is the premium, because mortality rate is going to be lower, wherein higher the age, higher is going to be the premium, because mortality rate will be higher at a higher age, right? So moving forward, let's understand expenses and reserves. Both comes under operating expenses, so let's deal both together. What are all the operating expenses a life insurance company will have to do? For instance, agent training and recruitment, commission given to agent for the business sourced. We will have employees working in a life insurance company, so that their salaries will come under operating expenses. The cost spent towards rent of office accommodation, stationery, electricity, and many other miscellaneous charges to run a full-fledged company. All these costs will come under types of operating expenses. All these have to be added towards the expenses and reserves. So what we saw is, it is not the fundamental premium alone being charged to the customer, or the profits which we are sharing with the customer in certain products to be added to the premium, but also the expenses and reserves. Sometimes there are other factors which we have to consider as far as managing the reserves. For instance, if there is a lapse or a withdrawal. Lapse is nothing but the customer does not continue paying premium for a longer term. For instance, he agrees to pay for 15 years, he pays for 3 years and decides to stop. So that's a lapsed policy. Depending on the feature of individual product, you will understand more about the lapsation, about those products of your company. Here in common, understand what is this concept lapse. There is a customer agrees to pay for a longer term, he pays only for 2-3 years and then decides to stop. So the policy lapses. And the other risk in these policies is the customer decides to withdraw. He has taken for a 10-year term, but after 5 years he decides that he wants to withdraw. So lapsation and withdrawals impact the performance of the policy. So all these have to be put in consideration before deciding on the final premium for any product. And lastly, let's speak about bonus loading. So par products, for instance, par policies, if we recall from the initial traditional plans which we discussed in the earlier chapters, par policies have a bonus component which is declared year after year. So in general, for certain policies, certain par policies, a bonus component is loaded in the premium itself in addition to adding the performance gains. So this becomes a buffer in the product. So this adding bonus loading the final premium is arrived, right? So as shared earlier, profits are also shared as bonus to the policy holders, right? So in total, friends, if you see how a gross premium is arrived, it is the net premium plus loading for expenses plus loading for contingencies plus bonus loading. Should I do it for any product? I am again repeating, not necessary. You as an individual will be given a premium table or a premium calculator. Using that, you will only share the gross premium to your customers. We will not be knowing the breakup of what is the expenses or what is the loading for contingencies or what is the loading for bonus, right? So to add more, we spoke about a term bonus. Bonus is the profit shared with the customers and the shareholders. So let's understand more about surplus and bonus. There are 4 concepts which you need to understand in surplus and bonus. The 4 concepts include determination of surplus and bonus, bonus itself as a concept, unit linked policies, and the contribution method, right? So let's go one after the other. Determination of surplus and bonus is done on a periodic basis, for instance on a half-yearly basis or on an annual basis. This is done mainly to understand the organization's status, whether it is solvent or insolvent. The life insurer does this regularly to check the financial status of the firm and to determine the surplus. If the organization is doing good, if the life insurer is doing good, to determine the surplus for distribution among policy holders and shareholders as a bonus, right? So determination of surplus and bonus is completely dependent on the excess of assets. So for instance, we say that a life insurer is in surplus state if the assets are in excess to the liabilities, and the strain status if it is in negative surplus. That means liabilities are higher than the assets. So excess of income is shared as profit to the policy holder, right? So it comes in the form of a bonus. So surplus is assets minus liabilities. A simple understanding. You have to put yourself as a life insurer, and if I am the life insurance company, how will I see my surplus and bonus? So what are all the liabilities? So what are all the liabilities? Value of all payments that have to be made less than the value of premiums expected to be received, including all the expenses, will come under liabilities. So the present value is arrived based on a rate of discount using the interest table. So understand the basic concept. You need not get into actual calculation. There are specialists in this role in a life insurance company called actuaries who keep doing this for the companies. So for you, it is for you to understand how your business will impact the organization performance, right? So moving forward, insurers have to declare and distribute the divisible surplus, which is called as the bonus, and they have to share it with the shareholders and the policy holders, right? So let's understand more about the bonus. The most common form of bonus is the reversionary bonus, right? So in reversionary bonus, there are multiple varieties. We will discuss about the various reversionary bonus. A reversionary bonus is given to the policy holder when there is a maturity or there is a death claim, right? So if the policy accrues a bonus at a certain number of years, and then if the policy comes to surrender, till the policy will be eligible for bonus, right? So there are various types of reversionary bonus. To understand few: terminal bonus, compound bonus, simple reversionary bonus, and super compound bonus. So to understand few bonus types, let's read through the chapter further, right? So in the most common bonus shared with the customer is a simple reversionary bonus. It is expressed as a percent of basic sum assured taken on an annual basis, and it gets added to the policy account. Compound bonus is whatever is the bonus being declared, it is declared on the sum assured as well as the already accrued bonus. So that means it is like a bonus on a bonus, so it becomes compounded, right? So terminal bonus, this is paid at the end of the term. For a particular year, whenever the policy is getting matured, there will be a terminal bonus declared by the life insurer based on various products. So for instance, terminal bonus declared in one particular year, 2012-13, may not be applicable for 2013-14. So this is being declared year after year based on the performance of the life insurer as a firm, right? So let's understand more on the contribution method. We are moving from bonus to contribution method. Dividends paid to the customer can be in form of cash, it can be adjusted towards future premiums, it can be adjusted towards pending premiums or policy credit accumulation. So these are the four methods used to pay bonus to the customers. We will also understand about unit linked policies, but if you recall, we have read about unit linked policies in detail in chapter 4. If you want to revisit, please do read chapter 4 module which was shared earlier to understand more about unit linked policies. With that, friends, we come to an end of chapter 6. So I would request you, please go read the study material available, continue watching the video, definitely watch the Q&A sample questions, and keep referring the entire question bank available for you to prepare for the examination. So let's move on to the 7th chapter. And as mentioned earlier, in life insurance segment in IC 38 module, we have 9 chapters, and it's time to start the 7th chapter. Good luck, friends. All the best and happy learning.